All right, let's jump right in because some major numbers on the US economy just dropped. And honestly, they're making waves. We are talking about the lowest inflation rate we've seen in nearly 5 years. So is the fight really over? Let's get into it. So the latest report just came out from the Bureau of Labor Statistics for January 2026. And, for the first time in what feels like forever, the news was actually better than anyone predicted. So what is that new magic number? And there you have it, 2.4%. I mean, wow, that is a huge drop. And it's the lowest we've seen this number in almost 5 years. On the surface, this looks like absolutely fantastic news, right? But that is the multi-trillion-dollar question, isn't it? Before we all start celebrating, there is a catch. And it's a pretty big one, actually. It explains exactly why the Federal Reserve isn't taking a victory lap just yet. See, the real story here is way more complicated than just one number. Okay, so let's really dig into the details of this report. What exactly happened to cause this, surprisingly big drop? You can really see that clear downward trend, can't you? We went from 2.7% in December all the way down to 2.4% in January. So what was the main thing that pushed it down? It pretty much all comes down to one thing, your gas tank. Seriously. Energy prices just plummeted last month, down 1.5%. That single drop is almost entirely responsible for pulling that big headline number down. But this is where the picture starts to get, a little messy. Because even though that official number says 2.4%, that's just not the reality a lot of people are feeling in their day-to-day lives. It's really become a tale of two completely different economies. We're in this sort of K-shaped reality right now, where things are going in two totally different directions for different people. If you've got money in the stock market, you're probably feeling great with the recent rallies. But if you're living paycheck to paycheck, this lower inflation hasn't made your rent or grocery bills any cheaper. And that split makes it incredibly tricky for policymakers to make a move without hurting somebody. And hey, this isn't just a gut feeling. There's data to back it up. Joanne Hu over at the University of Michigan points out that for a whole lot of people, the anxiety about high prices and even job security is still very, very real. That cost of living just feels heavy. Now, to really get why there's so much caution, we have to look at a different number. Let's talk about core inflation. Basically, this is the number you get when you strip out the crazy up and down prices of food and energy. It gives you a much clearer picture of what's really going on. And you better believe it's the number the Federal Reserve obsesses over. And here it is, core inflation is sitting at 2.5%. Did you catch that? It's actually higher than the headline number. So the big takeaway is, once you ignore those falling gas prices, the underlying inflation is proving to be a lot stickier than anyone would like. And this single number, it explains everything about the Fed's next move. Which, of course, brings us to the Federal Reserve. Because while Wall Street might be popping the champagne, you can be sure the Fed is nowhere near declaring victory. So on one side, you've got the market analysts. They see 2.4% and they're shouting, that's it, the Fed has to cut interest rates now. From their point of view, the war is won and it's time to make borrowing cheaper and get the economy really humming. But the Fed, they see this completely differently. Their thinking is, look, this is just one good report. They are absolutely terrified of cutting rates too soon only to watch inflation come roaring right back. So they're holding the line until they are 100% sure they've got this thing beat. So what's keeping them up at night? They're laser-focused on things like super core inflation. That's the cost of services, not including housing. And the big one, shelter costs. Rent and housing prices are still going up, and that's a massive chunk of most people's budgets. Until those key areas cool down, the Fed isn't budging because their official target is and remains a firm 2.0%. And this isn't just a story about the U.S. central banks. Investors, policymakers all over the world are watching these numbers just as closely as we are. Because whatever the Fed does next is going to send ripples across the entire globe. This gives you a pretty great snapshot of the whole global puzzle. You've got the US holding steady. Then there's Europe, which is in a really tough spot. They want to cut rates too, but they're kind of waiting for the US to go first so their currencies don't get thrown out of whack. And then over in China, they have the exact opposite problem. Super low inflation, almost deflation. So they're trying to pump up their economy, especially that struggling real estate market. It just shows you how connected all of this is. So how are global markets reacting? Well, they're placing some huge bets that this is it, the beginning of what they're calling the Great Disinflation. Big money is moving into safe assets like U.S. government bonds.
all based on the idea that interest rates have finally peaked and this long, painful inflation fight is finally coming to an end. Okay, so we've looked at the data, we've talked about the Fed, we've even taken a peek at the rest of the world. But let's bring it all back home. What does all this economic jargon actually mean for you?
And that leaves us with this huge disconnect, right? The official number is 2.4%. But for so many of us, the price of rent, groceries, and just about everything else still feels sky high. So the real question is, when you go to the store or pay your bills, which number feels more real? Does it feel like 2.4%? Or does it still feel a lot closer to that 10% we were all dealing with not too long ago? That gap right there is the central mystery of the economy today.